Welcome to Pro News Weekly. Let's dive into the latest updates from the financial markets. The dollar is getting spooked by rivals. Stock indices are hitting all-time highs. Gold is pacing like a caged tiger. And Bitcoin is gearing up for new records. The US dollar is losing ground. Its index is being pressured by more than just White House policy, a cooling economy, and rising expectations of an upcoming Fed rate cut. The dollar's main rival is gaining strength. The trade-weighted euro reached a new high, boosted by Germany's fiscal stimulus, increased EU defense spending, and capital inflows into European securities markets. Euro-USD surged to its highest level in over 3 years. The current 9-day rally is the longest since 2024 and has alarmed the ECB. Vice President Luis de Guindos stated that $1.17 for the euro is acceptable, but $1.20 is not good news for the export-oriented Eurozone economy. The dollar index also took a hit from Donald Trump's renewed criticism of the Fed chair, the first drop in U.S. private sector employment since 2023, according to ADP, and Jerome Powell's remarks about keeping the Fed flexible. At a central bank meeting in Portugal, Powell stated that rate cuts shouldn't be ruled out at any of the upcoming FOMC meetings. The S&P 500 continues breaking records. The broad index shrugs off bad news and rallies on any positive headline. A 13.5% drop in Tesla's global sales somehow triggered a 5% rise in its stock price. Investors welcomed the company's increased investments in artificial intelligence technology. Weaker job market data is seen as a reason for the Fed to cut rates soon. Trump's trade deal with Vietnam is being interpreted as de-escalation in trade tensions, even though the country will face tariffs of 20 to 40%. Retail investors keep buying the dips. Market professionals see little reason to fight the crowd, given the still strong economy, slowing inflation, improved corporate earnings, and renewed investor interest in AI. Among the Magnificent Seven, Microsoft, Nvidia, and Meta are driving the market higher, while Apple, Alphabet, and Tesla are dragging it down. Seasonality is also supporting the S&P 500. The last time it ended July in the red was 2014. On average, the index gains 1.67% in the second month of summer. The de-escalation of the Middle East conflict reduced demand for safe haven assets, pushing gold to a one-month low. However, it managed to stabilize thanks to the U.S. Senate passing Donald Trump's big and beautiful tax cut bill, the renewed feud between the president and Elon Musk, and disappointing ADP private sector jobs data. Fiscal stimulus worth $4.5 trillion, paired with $1.2 trillion in budget cuts, has raised concerns about the Treasury's ability to finance the deficit. A cooling U.S. economy increases the likelihood of a Fed rate cut in July. Meanwhile, the conflict between the world's richest and most powerful men has markets looking for safety. Still, Trump's massive tax bill could fuel U.S. economic growth and inflation, forcing the Fed to keep rates high, which would negatively impact gold. Bitcoin is becoming less speculative and more like a traditional asset. Its 30-day implied volatility fell to the lowest level in 2 years. For the past 2 months, Bitcoin has traded in a narrow $93,000 to $111,000 range, one of the tightest in its history. The days of 5 to 10% single-day swings appear to be over. Key reasons include better infrastructure, new trading instruments, and the crowding out of small players by institutional investors. Reduced volatility makes Bitcoin more predictable. Its future depends largely on global risk appetite. More than 60 publicly traded companies, from Japan's Metaplanet to UK-based Coincilium and the Smarter Web company, now use Bitcoin as an inflation hedge. Crypto is proving more profitable than traditional markets. BlackRock's Bitcoin ETF generated $187.2 million in annual fees thanks to higher commission rates. Its flagship S&P 500 fund, with far more assets, is less efficient by comparison. The key event heading into July 11th is the expiration of the White House's 90-day tariff delay. Trump insists there's no need for an extension. His deal with Vietnam raises the chances of more last-minute trade agreements. The more deals signed, the greater the potential for continued rallies in U.S. stock indices. However, market overconfidence could backfire. Investors believe things can't get worse and expect no return to the July 4th-era import tariffs. If they're wrong, the S&P 500 may face a correction, and global risk appetite could weaken. This week's economic highlight is the release of the FOMC meeting minutes. In June, projections were updated and the Fed funds rate held steady at 4.5%. Since then, much has changed, even Powell's stance. In testimony before Congress, he signaled no easing before September. But at the Sintra Forum in Portugal, he admitted he wouldn't rule out cuts at upcoming meetings. Stay tuned to Pro News Weekly for more global market updates. Like, share, and subscribe.